Imagine living in a world where you could have billions without paying a single cent in taxes. That's the reality for America's ultra-wealthy elite. Billionaires like Jeff Bezos, Elon Musk, and Larry Ellison have found a clever loophole, borrowing against their assets to live like kings without triggering income or capital gains taxes. But what if there was a way to tax the untaxed billions of the super rich and finally make them pay their fair share? Despite their seemingly everywhere presence, America's elite billionaires are actually a pretty exclusive club. As of 2023, only 735 billionaires called the US home. That might sound like a lot, but it's just about the size of some American high school graduating class. On the other hand, America's rocking 40% of the world's millionaires. Dwayne Johnson, aka The Rock, at $800 million, Dolly Parton with $650 million, Adam Sandler at $440 million, George Clooney at $500 million, Tom Cruise at $600 million, and J-Lo at $400 million, just to name a few. Elon Musk rules the billionaire club with a jaw-dropping net worth of around $250 billion, towering $90 billion above Jeff Bezos from Amazon. Other big shots in the billionaire arena include Larry Ellison from Oracle, holding $158 billion, the evergreen Warren Buffett's still in the top 5 with a whopping $121 billion, Bill Gates is flaunting an impressive $111 billion, and Mark Zuckerberg sitting pretty with $106 billion. In 2018, just the top 25 richest Americans collectively sat on $1.1 trillion, a sum equal to over 14 million average U.S. salaries rolled into one. This ultra-wealthy elite paid $1.9 billion in federal income taxes that year. That's a lot, right? But wait. Ordinary Americans paid $143 billion in taxes in the same year. Jeff Bezos paid zero federal income tax in 2007 and 2011 when his net worth hovered around $8 to $18 billion. Elon Musk did the same in 2018 when his net worth neared $20 billion. Carl Icahn managed this twice during that period. It's a scandalous reality where the ultra-rich accumulate incomprehensible fortunes while paying next to nothing in taxes on that dizzying wealth. So how have the mega-wealthy consistently avoided high tax burdens despite holding over $1 trillion in assets? They use the billionaire's tax-free money printer, aka the buy, borrow, die strategy. This crafty little loophole is a money printer for the 0.01%, letting them live like kings while paying peasant taxes. Here's how it works. Step 1. Buy up or own tons of appreciating assets like stocks, real estate, art, etc. Step 2. Take out stupidly low interest loans using those assets as collateral and write off the low interest on those loans as a tax deduction to minimize the overall tax bill. Step 3, kick the bucket, pass on all those assets to the heirs on a stepped-up basis, and pay no taxes on the capital gains. A billionaire doesn't sell assets when they want to buy a new mega yacht or golden toilet. Instead, they take out lines of credit that make a Las Vegas casino blush. We're talking open-ended, never repayment schedules on loans that just accrue interest like a credit card. Why sell assets and pay taxes when you can effectively print your own monopoly money and live like a king? Let's say you own 1 million shares of XYZ Corp at $1,000 per share. Poof! You're a paper billionaire. But probably the last thing you want to do is sell any of that stock. That's your controlling stake in the company. Instead, you head to the bank and ask for a line of credit using those XYZ Corp shares as collateral. No problem. They happily give you a $250 million securities-backed loan against the stock value. You take that $250 million, use, let's say, half of it to buy a mansion, a private jet, and a couple of ultra-rare hypercars, and use the remaining to make the low interest payments on the loan, which are also conveniently tax deductible. But here's the beautifully devious part. Stocks tend to appreciate over time. The S&P 500 grew 5 times in 30 years. After 30 years, when your portfolio balloons to $5 billion, you get another $500 million line of credit, buy more insanely expensive stuff, and use that new loan to keep paying the low interest. Rinse and repeat the borrow and splurge cycle until you meet your maker. Just a perpetual line of cheap credit funding your Richie Rich lifestyle, backed by your endlessly inflating corporate share value. By the end of 2020, Elon Musk had gone full-on Gordon Gekko, borrowing $23 billion against his Tesla shares. Oracle's co-founder, Larry Ellison, cashed in on a $21 billion loan, all backed by the company's stock portfolio. Our friendly Amazon overlord, Jeff Bezos, levered up over $20 billion in low-interest loans, and Carl Icahn got in on the debt orgy and convinced lenders to front him $5 billion. As stock prices go up, so does the size of the borrowing. Oracle stock prices doubled from 2020 to 2023, and Larry Ellison's personal loans went from $21 billion to over $30 billion. The line of credit loan isn't secured by any assets purchased with the loan. It's only backed by the collateral stocks. If shares take a dive, our beloved billionaires can just toss more collateral to avoid foreclosure. But what if the situation totally goes south? Take the example of the Chinese latte mogul Lu Jingyao, founder of Luckin Coffee Inc. This caffeine baron took out a $500 million loan against his publicly traded stocks. Then, in April 2020, Luckin admitted its COO might have just faked some sales numbers. Shares immediately cratered 90%, putting Jingyao's loan in a complete dumpster fire. The lender did manage to repossess and liquidate the pledged stocks for a paltry $200 million, leaving a $300 million hole. Did Jingyao pay up? Nope. He just ghosted on the $300 million and kept living that latte oligarch life with whatever wild splurges he funded with the original $500 million windfall. Billionaire bailout achieved. Now, you may be thinking there has to be a way to finally make these billionaires pay their fair share of taxes, right? Well, Professor Edward G. Fox from University of Michigan Law School and Professor Zachary Liskow from Yale Law School have recently proposed a brilliant outside-the-box solution. Tax the borrowed billions instead of the underlying wealth. The idea is elegantly simple, yet potentially game-changing. Rather than taxing income, capital gains, or total net worth, this approach would treat any loan secured by assets as a taxable event, similar to how asset sales are currently taxed. The billionaire borrowing strategy capitalizes on a notable quirk in the U.S. tax code, where assets, like hefty stacks of highly appreciated stock, usually need to be sold or swapped for the gains to be slapped with taxes. It's grounded in the idea, whether right or wrong, that gains only become legit once they're cold, hard cash. But here's the billionaire twist. They borrow against those gains, play with the cash, and suddenly it's not just gains on paper. Take Larry Ellison. He didn't just get wealthier on paper when he borrowed against his stock to buy a $300 million Hawaiian island. He practically turned his unrealized gains into an island adventure. Critics argue that the billionaire borrowing tax could discourage entrepreneurship. Still, proponents believe it's a fair way to compel the 0.001% to contribute their fair share. Who knows, if we really maximize the borrowing taxes, maybe we common folk could even get a tiny refund to upgrade those economy-class domestic flights to the premium cattle-class cabin. A few extra microns of legroom never hurt anybody. All kidding aside, it's a simple, innovative solution to enforce at least some level of tax contribution from the wealthiest individuals. What do you think of the billionaire borrowing tax? Share your thoughts in the comments section, and don't forget to smash the like button and subscribe for more financial entertainment. See you next time!